Okay, so this is going to be the midterm review for individual income tax. And so first of all, in this review, we're basically going to go over the vast majority of the types of questions that you'll see on the midterm that require actual calculations. So this will end up being about 40% of the questions on the midterm. See if I'm counting that right. Yeah, 30 to 40% of the questions on the midterm will involve these types of calculations. And then the rest of them, like this first part of this slide is talking about here, will be definition type questions. So it'll be more conceptual, and these will be ones that if you read the chapters and paid attention, you probably have a decent idea of without even looking them up. And if not, then you should be able to look them up relatively easily. Anyway, they'll just be short answer type questions. The midterm is going to be, I think I mentioned this before, but it's going to be just a document that you download, and then you'll answer it on either in a blank Word document or a blank Excel spreadsheet, and save it and upload it. And the midterm should be posted soon. I'm almost done with it. I wrote most of it while I was writing this review so that the question types are fairly similar. Okay, so let's move into that. There's only really chapters 2, 3, 4, and 5 that have substantive calculation type questions in them. So you may see some definitional type questions from chapter 1, and then basically 2 to 3 calculation type questions for chapters 2, 3, and 2, 3, 4, and 5. And then for each one of those chapters, maybe 2 or 3 just conceptual type questions, and that'll be the midterm. So, first question. In the following situation, indicate whether the taxpayer qualifies as a head of household. Davey is not divorced, but lived apart from his wife for the entire year. He maintains a household for himself and his dependent daughter. He receives help from his wife to support their daughter. The payments amount to 15% of the support for their daughter. Can, under this situation, Davey qualify as head of household? So ordinarily, since he's not divorced, he would not qualify. So in this situation, you'd have to either remember from the chapter or go through and look for any exceptions to that rule that he needs to not be married in order to claim head of household. And if you did that, you would see the exception of abandoned spouse, which is on page 2-23. And you'll see that, I believe, as long as the spouse who did the abandoning did not contribute more than 50% of the support for their daughter, which in this case she did not. So as long as that's the case, then Davey can claim head of household because he is considered an abandoned spouse. Okay, so next question. Jackson provides support for his 28-year-old grandson Jimmy and Jimmy's boyfriend Tom. Jimmy has adopted 2 children. They both also receive support from Jackson. Jimmy lives in an apartment that costs $2,000 a month, of which Jackson pays $1,100. Jackson also pays a living stipend to Jimmy to support the family of $2,000 per month. Actual living costs for the family total to about $5,000 per month. So the first question, can Jackson claim a dependency exemption for Jimmy. So in this case, you would need to look up what the rules are about claiming a dependency exemption. And you would see that there are several of these tests that Jimmy fails as far as Jackson being able to claim him as a dependent. So the answer would be no, and that would be due to the fact that Jimmy fails the abode because he doesn't live with Jackson, age, because he doesn't live with Jackson at least half the year, age, because the fact that he's 28 years old, and support test because of not meeting the 50% threshold. So next question, can Jimmy claim his adopted children as dependents? So we're asking, can Jimmy the son claim his own adopted children as dependents? Answer to that is yes, because they are, adopted children are considered just like normal children, regular children, birth children, I guess I should say. And really the only thing you need to look for there is any situation where a certain person's children are not considered or not able to be claimed as dependents. So for this situation, since he's 28, it's unlikely that this would be possible, depending on what the ages of the children were when they were adopted. But there's nothing in the facts that suggests that the children are self-supporting, so we can say, or at least assume in this situation, that yes, he is able to claim them. So, in this case, who is entitled to the child credit for this is for the two adopted children? And the answer to that is that Jimmy is in fact entitled to the child credit because the children are his dependent children. From the facts that we have here, there's really no one else in this factual scenario who, at least that the facts suggest, should be able to claim the children. So based on that, we will assume that that Jimmy is the one who's able to claim the child credit. So, I mean, as we're going through these, you can see, and I know I've talked about this in class before, but, you know, basically it ends up being, as is similar with many different types of law, that you're basically in tax just looking at the factual situation. So, you know, reading in all the facts that you have about this scenario, and then just trying to recognize, based on the facts that you're given, where you should go look to make sure that you're getting the right answer. And that's basically what it boils down to as far as succeeding in doing taxes goes. Obviously, as you get more experience with it, a lot of the stuff that you encounter frequently, you won't have to look up. But as a new student, and if any of you go into tax as a new employee, you're pretty much going to have to be looking everything up. So I would say for now, you just get used to that, and then be happy when you don't have to look everything up anymore. Okay, next question. For each of the following items, indicate whether the individual taxpayer must include any amount in gross income. Employees of the City of Winchester are given a floating holiday to use on their birthdays. Yes, it must be included in gross income, and as an employee, basically, this is not a situation that you would really have to worry about it, because that is basically, you won't work that day, but the pay will show up just as part of your regular ordinary income. So, you know, it would kind of just be a non-issue. But yes, since it is the equivalent of just a paid holiday basically, and you're getting paid a salary on that day, it will show up as your normal salary on your paycheck. Okay, Google managers were given 50 shares each of Google common stock in lieu of a cash bonus of $20,000 at the end of the year. Again, this is another one that maybe if you remember from the reading or from class, you might key on the fact that this is a stock bonus or a certain amount of stock in lieu of a cash bonus. And we know that pretty much any time you see in lieu of cash, it's basically treated as the equivalent of actually receiving cash. So yes, it would be taxable. Okay, old company vehicles are being auctioned off on eBay. They all sold except for one 25-year-old Ford Fiesta with 640,000 miles on it. The floorboard is rusted out and only 2 of the 3 cylinders in the engine are working. The opening price for the Fiesta was $50 and there were no bidders or watchers throughout the auction. The car didn't sell. The car is given to Bob the janitor for free. Does Bob have to recognize this on his taxes? Basically, you would look at that factual scenario and you would say that, in fact, no, he really shouldn't have to recognize this, most likely because if it had any value, you would think that someone would have placed a bid on it, considering all of the other vehicles were purchased. So this would be just kind of a de minimis item, probably worth as much to the company to get rid of it as it is to Bob to get it, probably have to get it towed away from the company. Okay, next question. Amos retired from his job this year. He is single. He received a salary of $25,000 for the portion of the year that he worked, tax-exempt interest of $3,000, and dividends from domestic corporations of $2,700. Excuse me. On September 1st, he began receiving monthly pension payments of $1,000 and Social Security payments of $600. Assume an exclusion ratio of 40% for the pension. Amos owns a duplex that he rents to others. He received rent of $12,000 and incurred $17,000 of expenses related to the duplex. He continued to actively manage the property after he retired from his job. Compute Amos's adjusted gross income. Okay, so you're basically going to compute this as follows. You'll start with his salary, so $25,000. You'll add in his dividends from the domestic corporation of $2,700. You'll add 60% of the pension benefits that he received, which was only for, let's see, started in September 1st, so you have September, October, November, December. So that's $1,000 a month, but only 60% of that is what is going to be taxable. So that would be $600 a month, or $2,400. Then you're going to subtract out, let's see, the $5,000 of expenses related to the duplex. The net expenses, I guess I should say there. And then you're going to add in the taxable amount of Social Security, which is 50%. So since he received the Social Security for 4 months as well, that's a total of $2,400. Half of that's $1,200. And when you do the math there, the total should add up to $26,300. Again, for this type of question, unless you have how to deal with all of these situations memorized, you would basically say, okay, I know that the salary is going to be in there. If you don't remember what to do with tax-exempt interest, you would go look that up. Look up what you do about domestic corporations, dividends from them anyway. Look up how you handle pension payments and what it means that there's an exclusion ratio of 40% there on the pension payments. How much of Social Security payments are taxable, and then what to do about the duplex that he rents out to others. And once you figure out how to handle each one of those factors, you'll see that basically the $3,000 of tax-exempt interest is the only part that we're not including in this, and the rest just basically show their either actual value or, in the case of Social Security, the 50% or the pension 60%. So again, these are just questions that you basically just need to know. You need to know what you need to know. So in this case, you need to know that you should look up individually each one of these classifications, unless you just remember how to do it offhand. Okay. So next question. Tommy has a $500,000 life insurance policy on his life. Over the course of time this policy has been in place, he has paid $25,000 in premiums. Dividends on the policy have totaled $22,000. Instead of withdrawing the dividends, Tommy left them on the policy. That's kind of just letting them accumulate in there. The insurance company credited $4,000 of interest on the accumulated dividends to Hank's account. First question then is, how much is Tommy obligated to report as income in connection with this policy? So basically you're going to look here at, well, you're going to look at the dividends. The fact that he leaves them on account doesn't really factor into this. So you look at the dividends and you'll see that the dividends are less than the premiums he's paid. So far you're not going to have to report any income on those. However, any amount of the interest on those dividends will count as income. So in this case, we're going to report the $4,000 of dividend interest as income. Again, doesn't matter that the amount was left on the policy. So the next question, would the answer to Part A change if dividends totaled $26,000 instead of $24,000? The answer to that is yes, it would change, because at that point you've received dividends greater than the amount of premiums that you've paid, and so again, regardless of whether they're left on account, however much excess you've received over the amount of premiums you've paid will be counted as income. So in this case, you would have the extra $1,000 of the $26,000 over the $25,000 in premiums. So the added difference of $1,000 would be considered income, and then of course the dividend interest would still be considered income. For each of the following, indicate the amount that must be included in the taxpayer's gross income. Milton recently began school to get his PhD in ancient Egyptian literature at Harvard. Milton received a tuition scholarship of $25,000 per year and a graduate assistantship that included a $1,500 a month stipend in exchange for 20 hours of work per week. So how much of that is going to be having to be included in the taxpayer's income? Well, with scholarships, if you remember, and again, if you don't remember, you would go look up how to deal with scholarships and in what situations scholarships are considered taxable income and in which situations they're not. And you would see that when it's allocated for tuition and fees, it is not considered income, but the entire graduate stipend would be considered taxable income because it's basically just considered to be a part-time job. and all of that money could be used for room and board, and basically could be used for anything, but it's not specifically allocated to tuition and fees. So the next part of the question, Jason received a wrestling scholarship to attend the Ohio State University. The total amount of the scholarship was $26,000 per year. The money was allocated in the following manner as set out in the award letter. $13,000 per year for tuition and fees, $2,000 per year for books, and the rest for room and board. So, of that scholarship money, how much of that is going to end up being taxable? Now you see that it's all a scholarship, so it's not, none of it is basically a job. It's all a scholarship. But again, we still have the same situation, and generally the $11,000 for room and board would be considered taxable. This one is slightly questionable because there is some indication that if the full award is contingent upon Jason actually wrestling for the school, and so like if he got the award and then injured himself and so wouldn't be able to perform and lost the scholarship because of that, if that was one of the clauses of the scholarship, the IRS actually, if they dug into it, would probably call that a job and consider the entire amount taxable. They haven't really, as of yet, done that to scholarship athletes, regardless of the terms of the scholarship. But you know, it is a possibility. Okay, next question. Diana owns a van that costs $30,000 and has been used for personal activities. Diana transferred the van to her business. When she transferred it to the business, it had a fair market value of $16,500. The business is operated as a sole proprietorship. What is the basis of the van for determining depreciation? So, I mean, this one's fairly simple if you remember the rule. If you don't, again, you just look up how to handle an individual turning private or personal property into business property. But the answer is whatever the fair market value is at the time that it's transferred to the business. That's going to be the basis for depreciation. So in this case, $16,500. What is the realized gain or loss if the van is sold for $9,500 after being depreciated by $8,000? Well, you just take the fair market value, take off the $8,000 that's been depreciated out. So that would leave you with a book value of $8,500, and you would just look at what it was sold for, $9,500. You would see that's $1,000 more than what the book value is, and so that would be a $1,000 gain realized. Okay, it's going to be the last question for the review. Like I said, this is not necessarily a comprehensive review of everything you could possibly see that's a calculation, but it does cover the vast majority of the calculation type problems that you would see on the midterm. Here we go. Melissa has a $55,000 adjusted gross income without considering the following information. During the year, she incurs a long-term capital loss of $12,000 and has a gain of $18,000 due to the sale of a capital asset held for more than a year. That would also be called a long-term capital gain. Assuming that that $18,000 long-term capital gain is improperly classified as ordinary income, what would Melissa's adjusted gross income be? Well, in that situation, you would just, well, first of all, you would look up basically how to handle a long-term capital loss if there's no long-term capital gain that you can use the long-term capital loss to cancel out. So you would just look up in any section talking about long-term capital loss and the nature of that, and in this situation we would add the $55,000 AGI. We would add $18,000 to that as ordinary income, since we're improperly saying that's what that long-term capital gain is. Add those two together. Actually, more correctly, let me put it out there like this. Add those two together, and then we would subtract out of the $12,000 the maximum that we're allowed to apply to ordinary income, which is $3,000. So we'd have 55 plus 18 minus 3 and total out to $70,000. Now, what if it actually had been classified properly? Then what should her AGI actually be? So in that case, we would have the $55,000, and then we would have the $18,000 long-term capital gain, which would be canceled out by all $12,000 of the long-term capital loss. So you would take the net of those two, and you would have a $6,000 long-term capital gain on top of the normal AGI of $55,000. So you would be left with an AGI of $61,000. And of course, the amount of that, we do want to make sure that we're keeping the long-term capital gains and losses separate, because of course capital gains are going to generally be taxed at a different rate than ordinary income. Okay, so that's the nature of the questions we'll look at. The fact patterns will change a little bit in the midterm, but that's, if you're comfortable with all of the calculations that we did here, you should be comfortable with the calculations that we're going to do on the exam. Other than that, if you have any questions, or if it looks like I made any mistakes on any of these questions that you want clarification on, just shoot me an email, let me know, and we can go from there.